So today we're going to talk about this strategy. I already explained you value investing is called. And the value investing requires financial understanding when you're analyzing the company. By the way, there are a lot of strategies where you have to understand financial statements. A lot of people believe that only for value investing you need to do it. No, practically for every type of investment which you want to do, you have to learn it. If you want to invest in IPO, right, you need to learn how to read raw statements, okay? Because usually for companies which go IPO, you won't find consolidated information from the sources which I'm going to show you in a few minutes, right? So you have to learn how to do it. If you're buying fast-moving, fast-growing companies, the companies which have 10-fold growth, okay, 10x growth, some companies are like that. You have to understand the business structure and you have to understand financial statements. You have to see that, okay? Warren Buffett usually doesn't invest in companies like that. Another thing, if you're trying to use the opportunities like right now in the stock market, for example, right now I'm using certain strategies which allow me to make money when the stock market goes down. But before I do that, because I allocate like a kind of shorting position, so I'm doing vice versa direction, I have to know that this company is bad. And this company, when the market goes down, this company is going to go even more down because this company performing much worse. Their profit going down, their sales going down, they have a lot of debt, they have a lot of red flags, which I consider a big kind of trigger for price fall. So that's why it doesn't really matter which strategy you use in the stock market, you need to understand fundamentals of the business, okay? And when Warren Buffett talks about value investing, specifically that strategy which we're going to cover today, he talks about only two rules. And one rule, buy only quality companies. And the second rule, buy only when they're undervalued. Okay. By the way, the word of value investing wasn't kind of introduced by Warren Buffett. Who knows, guys, who introduced value investing as it is? Like, I mean, one of the famous people who introduced this, just checking, correct me, Benjamin Graham, J100% Benjamin Graham. But Benjamin Graham and Warren Buffett, their investment style is different. And Warren Buffett initially was investing like Benjamin Graham. And if you heard those expressions about early investment of Warren Buffett, he was saying, we were buying cigarette butts, you know, so it's like when you buy in small, you have a couple puffs and you can throw it away. That's what they were doing. At that time, they didn't bother about quality of the companies because they were trying to buy companies deeply undervalued. Sometimes they would buy companies below asset value. They would liquidate the company, get it into bankruptcy, and then they sell assets separately and they make more money than putting it, okay? In some cases, there was, like at that time, at that period of time, it was possible to do. But then time changed. And the litigation processes, it started taking much longer and it became more expensive. You probably understand that lawyers, they cost a lot of money in the United States, but everywhere, right? And can you imagine if the company goes into liquidations, and even if the company has assets, and if this litigation process goes for long term, all these lawyers get paid, and they get paid first, and investors get paid last. So, and the situation happened with Warren Buffett, that he realized that when he buying company cheaper, undervalued, it's not a guarantee that after selling the assets, he gets all the money. Very often that part of it is going to go into the, you understand, debtors, but then work of lawyers. And that's why he put, no, I don't want to go through liquidations anymore again. I want the company to grow, to prosper, to develop. So that's why he put the rule number one. Before there wasn't rule number one, okay, because at that time was only rule number two. Okay, so guys, you understand it. Buffett Mentor, correct, man. Yeah. So now let's have a look. What the intrinsic value? What's the real value? What's the internal value? There is a lot of confusion on the market like that. It seems like so much information right now about this, but still a lot of people don't understand it. When they see undervalued, for whatever reason, they think cheap. And if they see the stock was $10 and now is $1, they believe it is undervalued. But it's not the case, right? Sometimes people see that the company cost, like, let's say $15, and another company completely $150. And they believe, oh, this company is good because it's only $15, and another company is bad because it's $150. It's too expensive, it's overvalued. But in reality, the company which is priced for $150 a share, it's actually undervalued a lot, because the amount of assets on that particular share may be $200, okay? And the cheaper company, which is $15 a share, maybe the asset value only $1, so the company is hugely overvalued. So that's why when you are trying to distinguish the price for the share, which you see publicly on any platform, brokerage platform, news platform, everywhere, right? Everyone can tell you how much the share, like, price at the moment, but very few people can tell you what's the intrinsic value. And sometimes it's not easy to calculate, and there are different formulas there how to calculate, okay? And we have our own formula how to calculate it as well. And different companies, you have to calculate in different way, because in some companies, the core like driver for the business is actually tangible assets. Would say if you're talking about car manufacturers, right, you understand that they have to have certain technology in order to build the cars and put all this electronics in these cars, right? And after that to sell. But if you talk about companies like Google, they don't have that tangible assets, because their competitiveness on the market will depend on what? On new technologies which they develop. It's in a code. They can create one code, and after that they make $1 billion on it. Okay, so, and when you're evaluating these companies, you have to look at different. Now, generally, Warren Buffett's approach is what we do. We calculate total assets. And if you calculate intangible assets, it's pretty easy to do that, right? Because you just look how much is the table, how much is the computer, how much is the car, how much is the house. You calculate all of this, and then you deduct liabilities which you have, and you get net asset value, right? You know that. But then again, how do you evaluate the new patents which company develop, right? So which they have new know-how, how to do certain stuff. Very often you cannot put a dollar value on that. So that's why they add another. You cannot just evaluate the business based on that. So you add another part. What's the future profit of the company? And I'll give you an example. Can you imagine the situation like that? We're educational business, and you decided to go into educational business as well, and you decided to provide certain rooms, let's say events, for companies like ours, right? And imagine you decided to buy a premises, and then to list these premises for different trainings on a daily basis for companies which provide the different trainings for anything, right? So you came to one particular, you look through internet, you found two advertisements, and you come, same building, same size of premises, let's say 100 square meters, both of them, okay? And you can buy them, let's assume in $50,000, okay, both of them. One $50,000, another $50,000. Now, both of them have equipment. They have flip charts, they have projectors, they have tables, they have a computer, right? Both of them exactly the same. And you know that because of that, the asset value is a bit high. And one company is selling their business, whole business, not only that particular room, for, would say, $60,000. And another company is selling the same type of room, exactly with everything the same, for $70,000. Guys, which one you're going to buy? Okay, maybe in Australia, in Sydney, you won't find that cheap premises, but still. So if you have exactly the same asset level, which one are you going to buy, for $60,000 or for $70,000? Put it in the chat. It's not a tricky question. It's a very simple question. But still, some people, they cannot make decision on that. So put it in chat. What would you buy, for $60,000, for $70,000? If you have this information on hand. Okay, 60, correct. Nick, completely correct. So $60,000, that's what you're going to pay. But then the owner, one owner who sells you for $70,000, it tells you, look, also, I'm not only giving you the room, I'm giving you the database of 500 businesses which run the events and trainings over the last 7 years in this company. Also, we already booked out for the next 3 months, and approximately the revenue which we are going to generate, it's about $5,000. When you come and ask the second guy who sells for $60,000, he sells, no database. You just, it's very simple. You just put an ad and people will come to you. So with the database, $70,000. Why? Because you already have exactly the value, and it's intangible asset, which very difficult to put price on. But you understand that also you have a future already revenue. For next 3 months, you already created $4,000. And it's not 100% sure, because if you have a partner, your partner might tell you, oh, you know what? But what happens if they refuse? What happens if they cancel? Anything can happen. And that's true. So instead of 4,000, you might get only 3,000 to maybe 2. Or if there is new restriction on COVID, 0, right? So there is a risk. But then the third partner is telling, third-year partner telling you, oh, no, look, it's fantastic. We're going to rent it also for different meetup groups in the evening. So we're generating not only $4,000, but actually on the top of that, we're generating another $1,000 or $2,000 extra. So when these 3 people, you're conservative, one is negative and another positive, right, from the projection, what happens? The future revenue projection might change. For one person, it can be higher, for one person is lower. That's why, guys, when you go on any analytical platform, you will see that some analysts, they will tell you one projection, and another analyst will tell you another projection. And it's just because they're humans. It's just because they kind of, one believes in the company more than another person. One is more strict than another. So that's why the intrinsic value is never the exact amount. The intrinsic value is a gap. It's a certain area between, for example, you can tell that the intrinsic value of that specific company between $10 and $12, 20% difference, right? So, but at least you know that if the price is $16 at that moment, so it's definitely above the intrinsic value of the company. But if the price is $8, so it's definitely undervalued. So guys, if you went, I don't know if you are new here and you see them first time, I definitely recommend you to go through our master classes where we analyze the different companies. Okay, if somebody here is here who never seen any master class from myself, so put a minus that you didn't see it, that I know is 0, that I know that you've never seen, and definitely I recommend you to watch at least one master class. I understand maybe you don't have an account open, but you will understand how we structure the master class and how we approach that evaluation, because in the masterclass, we always have the results of our analytical table where you can see exactly where we believe the fair value of the company, and we're always trying to buy when it is under those numbers. Okay. Now, so let's have a look like that. So that's our 5-step process. So the way we do, when we take the market, let's say if you decide to put $10,000 now, okay, and you think, okay, what should I buy? How will I find those companies? There is a certain screening process. So you have to learn how to do that. There are different platforms. So what you do, you insert certain parameters which you're looking in the company. And then I would say some databases, they have 7,000 companies. Within 1 minute, you narrow it down to, would say, 300 companies. Okay, very quickly, just putting quality parameters. So first what we do, we try to find the best companies from quality perspective. What is the best company? The company which grows in sales, they sell more product year after year and they increase the sales level. They increase the profit, because the sale is not only the thing, because you need to know how much money you put in your pocket after all the expenses. Then you need to understand what's the debt level, future growth projection, a lot of things, right? We're not going to cover it today, but you understand. That's how we distinguish the quality company. We have the table, special spreadsheet, where you put the numbers from the certain reports, which I'm going to show you in a minute, and it gives you an answer. But when you already know that, in order to find that company, you just insert it in the screening process, and bam, within 1 minute, you have a list of, let's say, 300 companies. The second step, out of those 300 companies, you need to find undervalued companies, which currently, for whatever reason, below the fair value. By knowing certain financial parameters, and it's not technical parameters, guys, it's not technical analysis, it's a fundamental parameters. You insert those numbers, and bam, out of these 300 companies, you might have only 10 companies which are undervalued. Okay, some of them would be little bit undervalued, some of them would be fair undervalued, and some of them deeply undervalued. Okay, then the next thing you do, you're trying to understand the reason why they're undervalued, and we're going to talk about it in the future as well, so in a few minutes. And after you understand the reason, you understand that there's certain companies, they might be forever going to be there because something happens in their business. That's why currently they're undervalued, but then they start losing money and they're going to go down forever, right? But some companies, they're temporarily there. It's like, again, if coming back to that example which I gave you about the company, Australian company, which is moving to China. And when you listened the director's report and they told you that it's going to be for 6 months and after that we're launching it, you know that from that point, 3 months later, they're going to produce new result, which is going to show the sales level in that particular region. And you can, okay, tell that's where the price move is going to happen. So I'm going to buy that share just before that. Okay, and that's where you're going to buy. So you identify the price level, at what level you want to buy. Okay, and the next very important stage, you have to understand, okay, I bought it at $10. What do I do after that? When do I sell? Okay, and you have to understand it before you even buy the stock, because a lot of people, what they do, they say, oh, I'm going to buy it. So at what price you're going to sell it? I don't know, I'll figure it out later. So they have no idea what is going to happen in the company. So by analyzing fundamentals, like in our table, at least what we have in our spreadsheet, when we analyze it, we buy it at this price, and that's where the company becomes overvalued. Guys like Warren Buffett, George Soros, other like active investors, what they do, they buy when it is undervalued and they sell it when overvalued. If the person is basing their decision on technical analysis, they buy at support, they sell at resistance. They all know where they enter and they all know where they exit before they open any position. Okay, but then another question is plan B, how to protect your investments. It's how to allocate certain shares in your portfolio, because some shares you might have a bit more, maybe 10% of your portfolio, but other shares you will have only 2% of your portfolio because they're a bit risky. You don't want to put 10% of your eggs in that particular basket because it's kind of a bit dangerous. Yes, it has higher potential, but then it has higher risks. So you'd better put only a small fraction of your portfolio there. Even if you lose part of it, you're still going to make money from other parts of your portfolio. Okay, this is very important, and also to learn hedging strategies, how to use it. And we're not going to talk about those hedging strategies today, but we're covering them during the program as well. So when we're teaching them.